Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's episode. We're talking about rule number 5 today. And back in 2017-18 when I wrote Investopoly, rule number 5 was described as set your asset allocation to reduce risk and maximize returns. And in Wealth by Design, I've now called it employ a value aware asset allocation. And this rule probably is where the biggest change has occurred. Like if you compare the two books side by side, this is probably one where I've materially moved. And as the title suggests of this podcast episode, I got it half right, or glass half full, a glass half empty probably is I got it half wrong. And, but I think it's not something that I'm proud to necessarily admit and reflect on, but also, I guess, just generally, my view is that if I go and read something or look at something that I wrote or prepared or analyzed, say, 5 years ago, I think it's really ordinary. I almost always think it's really ordinary and look at it and think I could do a much better job today, which is not a sense of kind of arrogance, but I guess we all try and hope that we advance in our thinking and our experience and, reflect on, any mistakes that have been made and these sorts of things, which is kind of one of the big drivers for me to rewrite Investopoly from the ground up. So I started, from blank sheet of paper and didn't really take much notice of Investopoly when I wrote the book. So the 8 rules haven't really changed per se, but there's been, some nuances and tightening in some of the rules. But this is the one, as I said, I think it's probably changed significantly, but I guess the theme of the rule hasn't changed. And the theme of the rule is that asset allocation matters. Asset allocation is an investor's most important decision because you can't control markets. You can't control the distribution of returns or the sequence of returns. You can't control, how long a flat or a down cycle lasts and how long a growth cycle lasts. What you can control, however, is where you invest your money and how you invest your money. So if it's shares, do you invest in different geographical markets? Do you use indexing? Do you use active fund management? Do you use direct stocks? How do you pick which markets you're going to invest in? When it's property, where you're going to invest in property, where's the location, all these sorts of things. They're the things that we can control 100%. What happens thereafter is completely out of our control. But if we get the initial decision right, so it's fundamentally sound, it's evidence-based, it's rules-based, we bought in an attractive price, it's a good quality asset, then typically, if we're dissatisfied with the short-term returns, the answer is probably just close your eyes and hang on for a little bit longer. And the longer you hold a fundamentally sound asset that you bought at an attractive price, the longer you hold such an asset using evidence-based strategy, the longer you hold that asset, the better off you'll be. So now knowing that asset allocation, or at least pointing out that asset allocation is our most important decision, you can see what mistakes people make from an asset allocation perspective. They might be chasing short-term returns, what's shiny, what's popular, or instead they might be procrastinating, having too much money in defensive assets, cash, just repaying debt, offsetting debt, doing those sorts of things because they're not quite ready or they don't think the market conditions are right to invest in growth assets. Either of those decisions are ultimately in the long run going to cost you in terms of future returns. Okay, so as always with these types of episodes, I've only got a few more to go, but with these types of episodes, I like to talk about, or refresh your mind what I said in Investopoly. So as I said, I wrote the book back in 2017, published in 2018, and there was a couple of key themes in the chapter. The first one was that returns are random, and Bernard Melke did a lot of research in this in the 70s. He wrote the book Random Walk Down Wall Street. That returns in the short run are very random, and that is still very true. In the short run, returns are driven by sentiment more than anything else. In the long run, fundamentals drive return. So therefore, it's impossible to pick which asset class is going to produce the best return over the next, say, 1 to 3 years, which I would regard as short term. So the answer is typically diversification, because if you have a finger in every pie, then you're going to pick up some of those returns. And also, if you invest in a variety of asset classes, you can't expect those asset classes to perform uniformly every single year on a straight line basis. There's going to be times where you invest in an asset class and even 3 to 5 years later, you've got some winners and you've got some losers. Over a 10-year period, you should have mostly winners, almost all winners. And over a 20-year period, if you've done well and not make any mistakes, it should all be winners. So the second thing I talked about in Investopoly was volatility, and volatility is a measure of risk. And so I talked about the traditional portfolio construction mechanisms, which is, really trying to reduce the portfolio's volatility by introducing defensive assets. Defensive assets tend to be income style assets where the capital value is relatively stable, like bonds, fixed interest, these sorts of assets. And then also I talked about correlation and that bonds were negatively correlated with shares. And so the benefit then of having a portfolio of bonds and shares, and there wasn't any correlation with property, so completely uncorrelated. So if you then invested your money in property, as in direct residential property, shares and bonds, that you've got a portfolio where either assets are moving independently or they're moving with a negative correlation, which means when shares don't do well, bonds do well, and it sort of smooths returns. That's all well and good, but bonds failed to deliver on that promise between 2020 and 22. It might be a faint memory now, but bonds were absolutely smashed in terms of capital value. So an asset class that, said, look, it's a safe asset, and it is statistically, when you look at history, it just didn't perform how we wanted it to perform in that early COVID period, which wasn't ideal because that's when you want bonds to perform in times of very high uncertainty. And when you have a look back at the history of bonds, over more than 100 years, I think there was only two or three. That was one of two or three occasions where it's done that. But to my mind, the tolerance for that sort of performance when you're investing in an asset that you believe to be safe to protect you in times of high uncertainty, the tolerance is zero to my mind. Like, okay, yes, it only has happened once in 100 years, but if we want safe assets, we want safe assets. So let's make sure they're going to do what they say on the tin. And then in Investopoly, I talked about having a strategic asset allocation with tactical tilts. So what I meant then by saying, well, let's just invest in the broad market. Let's use the index to say, well, the traditional market cap index that says, okay, well, this is what normal looks like in terms of an allocation, country allocation, sector allocation, and so forth. And then use tactical tilts to skew away from different allocations. So for example, if the US market accounts for 74% of the global index, it's roughly around that amount, maybe 76. Then you might say, and the US is overvalued. You might go, well, I only want 68% invested of my portfolio in the US market. So it's really about using the general index and then making tactical tilts. So none of what I talked about in Investopoly, I look back, was wrong per se. It was correct in terms of it was factually correct. And it was certainly in line with conventional wisdom. But upon reflection, I think my experience and I guess self-reflection and consideration has changed that approach significantly. And as I said, this is probably the rule that's changed the most. So I think, the core beliefs underlying the rule in Investopoly haven't really changed. Short-term returns are still random, still driven mostly by sentiment, still completely unpredictable. Certainly nothing's changed there. However, the view now is that long-term returns are not mysterious. Like, they're actually quite predictable, and valuation matters, and valuation metrics matter as well. Things like the CAPE ratio, which stands for cyclically adjusted PE ratio. And you could, there's a lot of arguments around at the moment in terms of, that ratio doesn't work anymore. AI's driven better productivity, these sorts of things. Look, I'm open to things changing, of course, and you've got to be open to things changing, but I don't think to the point, maybe it's not the as perfect metric to use anymore, but, the evidence is still there. And the evidence is that when there's a multiple expansion in a share market, so when prices are rising not only just because of earnings, but because expectations are rising, and when expectations get to a level that even if everyone's best case scenario plays off, that it's still not worth investing, then history tells us that those things don't work out so well. So, if you're going to buy a company at 50 times earnings, the only way you're ever going to make money because you paid 50 times earnings is if the company actually out-delivers its earnings growth and out-delivers everything in terms of at a very reduced risk rate. And so, when you're paying such exuberant prices, it tends not to work out. Similarly with property, if we look back to, when at the time of writing Investopoly, actually, when you look at the Brisbane property market, the 10 years through to 2017, 2018, when I published the book, were very ordinary. I remember holding an event, and I think it was the end of 17, holding an event at our office at Pro Solution in Melbourne. And I've still got the slide deck when I sort of said, well, this is why I think Brisbane looks really attractive. There was a bounce back in interstate migration, which the numbers didn't really matter in terms of migration numbers, but it was really just a sentiment story. So I think what it's showing us is there's signs, long-term signs that are available that make longer-term returns easier to predict, of course, than shorter-term returns. And so the key conclusion from there was that, and it naturally follows, that asset quality and price are far more important and replaced volatility and correlation as a way of managing investment risk. So really the three things you can control are which assets you own, so the quality of those assets, the price you pay for them, and how you spread your money across various assets. And I would rather own, or if I had some capital today, I would rather put 100% of that capital into one asset or one sub-asset class or one geographical market that I thought had very high quality of earnings, that was very attractively priced, as opposed to a traditional diversified allocation. And just for the sake of it, spreading my money across a broad-based index fund, for example, and buying everything regardless of price or quality. So price starts to become a more important metric than what I really spoke about in Investopoly. If you pay a high price, an asset must work harder just to deliver an acceptable return, because if I've overpaid, it needs to make up for my overpayment and then deliver the acceptable return. Whereas if I buy a quality asset at a discount, even a modest growth rate produces a result, because the capital growth is going to come from two sources: the organic growth within that asset. So if it's property, it's the organic increase in land value in a location, or if it's a stock or an index, it's the organic increase in, earnings and growth and these sorts of things. And the second part is the repricing. So if I buy something when the market is pricing those assets as cheap, so Melbourne residential property at the moment, for example, on a relative basis, on many, many measures compared to history, it looks cheap. Whereas if I'm looking at commercial property, again, as a general comment, small scale commercial property on a relative basis, on a cap rate, yield rate, is looking expensive. Like I did that episode a few weeks ago. So if I buy a commercial property and I overpay for that commercial property, then I'm already behind the eight ball, and my investment has to work harder to make up for that overpayment. Whereas if I just buy an average quality asset in Melbourne, residential, and I believe that the whole market will experience a mean reversion, then, I get the asset repricing uplift, and then I get the organic growth underneath that. So why the change? Well, I think over the last 8 years, I've witnessed and aggressively invested in, both personally and with client monies, in opportunities that have benefited from this value aware approach. So Brisbane, for example, a lot of clients that purchased in 2018 have probably doubled or getting close to doubling their money. Emerging markets, the UK market, was two themes in equities that we were, heavily investing in, I think even before the GFC, maybe certainly UK before the GFC, emerging markets kind of over that period. And there's been some investments again where we've more than doubled our money. So we've seen situations where valuations don't make sense. The underlying thesis behind the assets and fundamentals behind the assets were strong. And to my mind, that's the best way to minimize investment risk. So I'm not too worried about volatility anymore. I acknowledge that growth asset class are going to have higher volatility. I acknowledge it's more of a behavioral issue, so if I can make friends with the volatility and have the discipline to ride through markets, then I don't need to worry about volatility. Volatility starts to become important if I need to control behavior. But if I know I'm not going to sell at the wrong time or buy at the wrong time, then I'm okay. And so therefore, what I want to do is really focus on maximizing returns. The other major change since Investopoly was that I spoke about defensive assets like cash, money in offset accounts, bonds, fixed interest, hybrid securities, these sorts of defensive style assets. You could even to some extent throw infrastructure and maybe listed property into that, well, that tends to be more of a growth than defensive asset, somewhere in between. Anyway, the traditional approach in Investopoly was, well, let's put some of our portfolio, whether it's 10, 20, 30, 40%, into defensive assets to reduce the portfolio risk and reduce volatility. It would do that, and that's fine. Now my approach is more nuanced than that, to say that, okay, let's decide what level of wealth we want to hold in defensive assets, and that level of wealth should help us sort of ride out any market conditions. So we don't need to sell down. Not that it's unlikely there won't be something to sell at a reasonable price. It's unlikely that everything gets hit just as bad as each other, although in a major market crash that is true, at least in the first 6 to 12 months. But normally markets then gradually sort of recover from there on in, and it doesn't take that long to get back to where you were, except for maybe the GFC more recently. But again, if you had all your money in the US market, then of course, yes, that's true. But outside, other markets did okay and rebounded faster than that. So the answer then becomes, okay, let's put, say, 1 to 3 years worth of living expenses and let's hold them in very safe defensive assets. Again, whether that's money sitting in your offset account, whether it's bonds or fixed interest or term deposits or cash, whatever it might be. And probably not term deposits and cash. We don't tend to use them because there's better bonds that can give you high yield that are very liquid. Anyway, and then that means that if I feel comfortable that, hey, I've got 3 years worth of living expenses, I don't need to sell anything for 3 years. If a volatility event happens today, most likely I'm going to have something to sell over the next 3 years that I'm not going to regret selling at that particular price. So that's going to allow me to ride through any volatility, which means then I can put the rest of my portfolio into growth assets. And if I'm adopting a value-aware asset allocation, I'm buying good quality assets at a very attractive price, either fair value or attractive price. And if I do that, I know I've got a high probability that my 10 plus year returns are going to be very attractive. And to me, that's probably the approach that gives us the highest probability of maximizing our returns over the next 10 years. And because of that, to my mind, that's a lower risk approach than just general diversification. Now, I should clarify, when I say value-aware asset allocation, I'm not saying we're going to buy and sell all the time. But what I'm saying is when we contribute new capital into a portfolio, the question we must ask ourselves is, where can I buy the highest quality assets for the cheapest prices? That's what you want to ask. And if it means you're going to end up with a concentrated portfolio, I can wear that, because the chances are when I put capital in next year and the year after and year after, the answer might be different. And eventually, over time, I'll build out a defensive or diversified portfolio, I should say. But it's in terms of new capital. I would only sell if I became very, very uncomfortable with the exposure, either because the client's at a different stage of life and I don't want to take that risk, or I'm really concerned about the valuation risk where I want to take some profit. But normally what I like to do is rebalance through investing new monies. Diversification was still a very strong theme in Investopoly, and it's probably even stronger in Wealth by Design, and particularly the work that Campbell and I have done over the last few months or years in terms of being less in love with the Australian share market, being less than 2% in terms of value, less than 2% of total value of developed economies, but also being underweight in a lot of different sectors and being too overweight in minerals and financials. Of course, with the big banks, I'll say big 5 banks now, including Macquarie, and also the 2 big miners. So I think we've embraced that even more, and we want to access much better investment opportunities, much higher growth investment opportunities overseas, which reduces the tax drag too, of course, because we've got less income and more capital growth. And in Investopoly, I talked about Ray Dalio's all-weather asset allocation, which has been sort of back-tested and so forth, but it has some bonds and defensive exposure in there. I would just say, and we've done a podcast either, I can't remember if it's Campbell or myself, that, we talked about, well, if I'm investing and I'm in my 20s and 30s, for instance, or even 40s, why do I want bonds? I know bonds are going to be lower volatility, but in the long runs, bonds are also going to deliver lower returns. And I'm all just about, personally, I'm just speaking for myself here, not the advice I give, because it's going to be different for different clients. But for myself, I'm all just about maximizing returns. I don't really care what the performance is going to be over the next 1, 2, 3, 4 years. I'm only concerned about 10, 15, 20 years. And so if that is my goal, maximize returns, I don't want any bonds. I don't have any bonds in my super, neither does Campbell, and I have no intention, at least at this stage, in investing in bonds. So scrap all or Ray Dalio's all-weather asset allocation, and in fact, it's something that we're adopting more aggressively, or more diligently, I should say. Aggressively, not the right word, but more diligently with the right clients at Pro Solution. So what's the practical takeaways from, I guess, revisiting Investopoly versus Wealth by Design? Well, I guess the first thing is looking at defensive assets. And for most people, it's probably really looking at their asset allocation inside super. So what investment option have they adopted? And do they have any defensive assets in that asset allocation? And is that appropriate? I'm not saying it's going to suit everyone in terms of going all growth. It's absolutely not, but it's something to really think carefully about. Second, check your country bias. So how much of your portfolio is invested in Australia and why? And are you comfortable? Australia's underperformed over the last few years. So it's a popular kind of theme to say, but it's not really about past performance. It's really about understanding where future returns are going to come from. And given the market is dominated by only a handful of companies that you couldn't describe as high growth, then that's relative to investment opportunities overseas, then that's got to make you think about, really consider what will future returns look like. And it's entirely possible you might get sort of 4 or 5% in terms of yield and 3% of growth. That's good, but there's a taxation drag along with that. And then third and finally, where you're going to put the next amount of capital, your savings or your contribution. Thinking very carefully about your value-aware asset allocation. So don't just blindly put money in a diversified way. Think really carefully. You want quality assets at a very attractive price. Insist on quality, refuse to overpay, and hold for the long term. They're 3 really good rules to follow. Okay, you'll be sick and tired of me of saying by now that, of course, Wealth by Design's on pre-sale at the moment. It gets released in 2 weeks' time, 28th of July. Really excited for you guys to get access to the Notebook LM model, which is the AI tool that you can use to really extract more value from the book and help apply the concepts to your personal situation. And in next Thursday's episode, I'm going to talk about rule number 6 and why just buy index funds was good advice in 2018, but why evidence-based investing is better advice now. And next week's Wednesday episode is about automating cash flow management and using Claude, so using an AI tool. I've got a prompt to share. I've actually been teasing this episode for a couple of weeks, not on purpose, by the way. It's just I wanted to write about, whether investing in established property and live vesting as a strategy. I wanted to write about those 2 topics before I got to cash flow management. Anyway, that's next week. So until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.